Welcome back to the Deep Dive. Today, we are focusing on a project that has, well, arguably the most distinct and maybe the most stubborn personality in the entire crypto space.
Stubborn is a good word for it.
People have been calling it the tortoise of the industry for years. It's methodical, it's academic, and let's be honest, for a long time, critics called it painfully slow.
Oh, glacial was the word I used to hear all the time back in the early 20s. It was the project that was always researching, always, testing in a lab while everyone else was shipping code.
Exactly. We are talking, of course, about Cardano. But the reason we're pulling this apart today, Saturday, January 24, 2026, is because that whole narrative seems to be shifting right under our feet.
It really is.
The tortoise looks like it's strapping a massive rocket engine to its shell. We've got a historic 70 million ADA infrastructure bet that just passed. We have institutional doors swinging wide open at the CME Group, and the governance structure has completely fundamentally changed.
It's the ultimate test case for the industry. I mean, for years, the question was, can this academic peer-reviewed approach actually compete with the move fast and break things crowd? And 2026 is, it's looking like the year we finally get an answer.
So our mission today is to look past the price charts. And we will get there, I promise. And look at the plumbing. We're digging into the roadmap updates from late 2025, the new governance data from this Voltaire era, and of course the institutional reports. We're asking, has Cardano finally built a shell strong enough to outlast the hype? Or is it still moving too slowly?
It's a fascinating moment. All the theoretical pieces are finally becoming practical realities. Let's get into it.
Okay, so I want to start with the core identity here because Cardano just feels different from, say, an Ethereum or a Solana. It feels stricter.
Good word for it, yeah. You have to remember, Cardano was founded on this idea of high assurance. Most blockchains, they operate like software startups. You write code, you push it. If it breaks, you patch it later. That works fine for a photo sharing app. It doesn't work so well for a global financial system. Cardano operates more like the engineers building software for a Boeing 747 or, a nuclear power plant.
Measure twice, cut once philosophy.
More like measure 1,000 times, write a mathematical paper about the measurement, get that paper peer-reviewed by a bunch of academics at conferences, and then you cut. It relies on this thing called formal verification, which is basically mathematically proving that the code does exactly what it says it will do before it ever touches the live network.
Okay, which explains the slow criticism. If you have to prove everything mathematically, you can't just ship a new feature overnight.
Exactly.
But under the hood, the architecture is different too, right? I always hear about these two layers, the CSL and the CCL. Can you break that down for us without getting too bogged down in the weeds?
Yeah, it's actually a pretty brilliant simplification. Think about your bank account. You have the ledger that just says, John sent $50 to Sarah. That's the settlement. It's simple. It's just facts. But then you have all the complex stuff, the mortgage agreement, the escrow conditions, all the business logic. That's the computation. Cardano splits these. The CSL Cardano settlement layer is just for moving value. Simple, secure, very hard to break.
And the CCL is where all the complicated stuff happens.
The Cardano computation layer, that's where the smart contracts and the messy logic lives. By separating them, you make sure that even if a smart contract goes totally haywire and clogs up the computation layer, it doesn't freeze the ability to just send money on the settlement layer.
That makes a ton of sense. It prevents those insane gas fee spikes we used to see on Ethereum, where buying a digital cat would cost $50 just because the network was congested.
Exactly. And that brings us to where we are right now in January 2026. Because for a long time, the criticism wasn't just about the tech, it was about who was in charge. But that has totally changed. We are officially in the Voltaire era.
Voltaire. It sounds very dramatic.
It is pretty dramatic in terms of scope. It's the final phase of their original roadmap. And it means Cardano has basically transitioned from a federated management style, where the founding companies like IOG held all the keys to full on-chain governance. This whole thing is defined by a proposal called CIP Up 1694.
I've seen that acronym floating around. But practically, what does that mean? Who's in charge now? If I hold some ADA, do I run the network?
In a way, yeah. But it's not a direct democracy where every tiny decision is some chaotic referendum. It's what they call a tricameral structure. Think of it like a government with 3 houses.
The digital parliament.
Precisely. First, you have the Constitutional Committee. Their only job is to make sure any new governance action doesn't violate the Cardano Constitution. They're like the Supreme Court. They don't make policy. They just check for legality.
Okay, so that's check number 1. Who's next?
Then you have the DREPs, or delegated representatives. These are people or organizations that ADA holders can delegate their voting power to. It's like electing a representative to vote on your behalf on the actual proposals.
Got it. And the third.
And finally, you have the SPOs, the stake pool operators. These are the folks actually running the servers that secure the network. They have a check on any decisions that are critical to security.
So it's a whole system of checks and balances.
And that's the key insight. As of right now, early 2026, Cardano is effectively the only top 10 blockchain with a fully decentralized on-chain governance model that is actually live. It's not a roadmap item anymore. It's running the show.
Which is impressive, but let's play devil's advocate here. Governance is, well, it's boring to the average user.
Sure.
Users care about speed. And for years, the big knock on Cardano has been the ghost chain narrative. You know, it's secure, sure, but it's slow, and nobody's even using it.
That has been the primary criticism, yeah. The ghost chain insult. And to be fair, in the early days, the throughput just wasn't there. But if you look at the data from late 2025, that narrative is getting hammered by reality. We have to talk about Hydra.
Hail Hydra. Sorry, couldn't resist.
Hey, something like that. Hydra is their layer 2 scaling solution. The best analogy is a supermarket. The main blockchain is the main checkout line. If everyone tries to pay it once, the line goes out the door.
Right.
Hydra effectively opens up an unlimited number of express checkout lanes that operate offline or off-chain.
So I can transact with you back and forth 1 million times in our own private lane, and we only bother the main cashier when we're done and want to settle the final tab.
That's it, exactly. And the speed is just absurd. In testing back in December 2025, Hydra heads hit a peak throughput of 111,000 transactions per second.
111,000. And for context, Visa handles what? Maybe 24,000 on a busy day?
Significantly faster than Visa. So theoretically, Hydra solves the payment speed issue. But what I find even more fascinating is what they're doing to the main blockchain itself. There's an upgrade coming in Q1 of this year called Ouroboros Leos.
Leos. Okay, so this is different from Hydra.
Completely different. Hydra is a layer 2. Leos is upgrading the layer 1 engine itself. It solves this really tricky problem called the block time trade-off. See, traditionally, a validator has to do 3 things in order. Check the transaction, bundle it into a block, and then broadcast it. It's a bottleneck.
It's single file line.
Leos breaks that up. It introduces something called input endorsers. It lets transactions be validated and streamed constantly in parallel while the blocks are built separately. It decouples the doing from the recording.
So you've got multiple conveyor belts all running at the same time.
Exactly. And the projection is that this pushes the base layer, not a layer 2, but the base chain itself, to somewhere between 1,000 and 10,000 transactions per second. And the kicker, it does this without requiring, a supercomputer to run a node.
That's the dig at Solana, right?
It is. To run a high-speed node on some of these other chains, you need an industrial-grade server farm. Leos aims to keep the hardware requirements low, which helps keep the network decentralized.
Okay, so technically the slow argument is dead. Or at least the technology to kill it is finally here. But speed doesn't matter if you don't have privacy. And this feels like a big pivot we've seen recently. A lot of talk about something called Midnight.
This is huge for the enterprise crowd. Midnight is a side chain, a partner chain to Cardano, that focuses on what they're calling rational privacy.
Rational privacy. That kind of implies there's an irrational privacy.
Well, there's what you might call anarchist privacy. Think Tornado Cash. Total anonymity, often used by bad actors and absolutely hated by governments. Rational privacy is different. It uses zero-knowledge proofs, or ZK snarks.
Let's unpack that. ZK snarks.
Okay, think of it like going to a bar. The bouncer needs to know you're over 21. Normally, you hand him your ID. He sees your name, your address, your exact birthday. He sees way too much.
Right, he gets the whole dossier.
A zero-knowledge proof is like a magic ID card that just turns green if you're over 21. The bouncer knows you're legal, but he learns absolutely nothing else about you.
So apply to a business.
The company can prove they have the funds to cover a loan without revealing their entire bank balance to a competitor. A supply chain can prove a product is authentic without revealing their whole list of suppliers. It's the holy grail for regulated industries. They need privacy compliance, not total anonymity.
And Midnight is actually live.
The token, NIHT, it launched back on December 8, 2025. And it's really cleverly integrated. The stake pool operators can actually dual mine. They can secure the Cardano network and the Midnight network at the same time, earning rewards in both ADA and NIT.
That's a smart way to bootstrap security. You're just using the existing army of validators.
It connects the ecosystems. And speaking of connections, we have to talk about Bitcoin.
I saw this. Cardano and Bitcoin, they don't usually play nice together.
They do now, through something called the Rosen Bridge. Now, bridges in crypto are, they're scary. We've all seen the hacks. Usually, a bridge is just a centralized server holding a bunch of keys. If that server gets hacked, poof, the money's gone.
The honeypot problem, right?
Rosen is different. It uses a decentralized system of watchers and guards. It's much, much harder to compromise. And recently, they integrated Bitcoin runes.
Runes are the new token standard on Bitcoin.
Yep. So imagine you have a Bitcoin-based token. You can now bridge it over to Cardano and use it in Cardano's DeFi ecosystem lending, borrowing, trading way faster and cheaper than you ever could on Bitcoin itself. It's breaking down that isolationism that Cardano was accused of for years.
And we're seeing real-world utility starting to pop up, too. I was reading about the Cardano card partnership with Wirex.
Right. That launched late last year. It lets you spend ADA at 40 million merchants. And there's a partnership with Petrobras, the Brazilian energy giant. They're using Cardano for blockchain education and sustainability tracking. These aren't just white papers anymore, they're actual integrations.
Okay, so let's take stock. We've got the high assurance tech, we've got the Voltaire governance, we have the privacy layer. But I have to push back a little here. If you look at DeFi right now, the total value locked, the amount of money actually being used in the system is, well, it's not great compared to Ethereum or Solana.
You're absolutely right. There is a massive gap. As of January 2026, Cardano's TVL is around $680 million. Now, that is up 42% since Q3 2025, which is healthy growth, but
compared to Ethereum's billions, it's a drop in the bucket.
It's a drop in the bucket, and the ecosystem knows this, which leads us to the biggest news of the week, the 70 million ADA proposal. This feels like a real all-in moment.
It really does.
This is the Pentat proposal. 5 major entities, IOG, the Cardano Foundation, Emergo, Intersect, and the Midnight Foundation, they all came together and basically admitted, we have an infrastructure problem.
Because they realized the philosophy alone wasn't enough.
They realized they didn't have the plumbing that big money needs. See, a hedge fund doesn't care about formal verification if they can't put the asset in their preferred custody provider.
So what are they buying with 70 million ADA? That's what, roughly $30 million?
They're buying the boring stuff. They are paying for integrations with Tier 1 stablecoins like USDC and USDT. For years, Cardano had to rely on these native stablecoins, which, fragments liquidity. They're paying for institutional custody solutions like Fireblocks and BitGo. And they're paying for major oracles like Pyth and Chainlink to feed in price data.
It sounds so obvious. Why didn't they just do this 3 years ago?
That's the million-dollar question. Some argue it was a principled stand, a refusal to pay integration fees to centralized companies. Cardano wanted to build everything itself. This proposal is a massive pivot to pragmatism. It's an admission that you can't be an island.
And the governance aspect of this.
This is the really cool part. This wasn't some backroom deal. It was a formal governance proposal. And it passed with 60% approval from the DREPs. It proves that this new Voltaire system isn't just a debating society. It can actually write big checks to steer the ship.
And the timing seems incredibly suspicious in a good way. Because just as they're finally fixing the custody plumbing, you have Wall Street knocking on the door.
The CME Group.
The Chicago Mercantile Exchange. I mean, this is the big leagues.
It is the biggest news for the suit and tie crowd. The CME Group is launching Cardano futures on February 9, 2026.
That's just a couple weeks away. Why does this matter so much? I mean, I can already buy ADA on Coinbase.
You can, but a regulated pension fund generally can't, or a risk-managed hedge fund. They need a way to hedge their bet. Futures allow institutions to short the asset to protect their downside. It puts ADA in the same regulated asset class as Bitcoin and Ether. It legitimizes it in a way that a listing on Binance just doesn't.
It invites the people with the deepest pockets to the table.
Exactly. It completely solves the access problem.
So we have the tech, we have the governance, the money, and the access. Let's translate this for the listener who's looking at their portfolio, because despite all of this, if I look at the chart, ADA has been sluggish.
That's putting it politely. In January 2026, ADA is trading in the 35 to 40 cent range. It hasn't pulled a Solana-style 10x yet.
So what's the bear case here? Why isn't the market reacting?
The bear view is It's a chicken and egg problem. Low liquidity keeps the big stablecoins away, and the lack of those stablecoins keeps the liquidity low. The bears argue that this 70 million ADA spend is too little, too late. They think the perception reset hasn't fully happened yet, that people still see Cardano as the slow academic project from 2021.
But there's a bull case.
Oh, a very strong one. And it starts with supply. Just look at the staking numbers. Over 60% of the entire ADA supply is staked.
Which means it's locked up.
Well, it's liquid staking, so it's not locked in a prison, since users can unstake anytime, but it is actively securing the network. It represents a user base that is committed. It creates a massive supply shock. There's very little liquid supply just sitting on exchanges waiting to be sold. So if demand kicks in,
The price floor is high.
the price floor is very high. And there are demand drivers. The ETF narrative is a big one. In January 2026, Cyber Hornet ETF LLC, great name, by the way.
Yeah.
They filed for a spot S&P Crypto 10 ETF.
And ADA is in that basket.
It's got a 0.5% allocation. Now, it's small, but it sets a precedent. If ADA gets included in these broad market crypto ETFs, that is automatic passive buying pressure. Every time someone buys that ETF, they're buying a little bit of ADA, whether they know it or not.
Plus the technicals look good.
We saw a golden cross on the charts in early January. That's when the short-term moving average crosses above the long-term. It's usually a pretty strong signal that momentum is flipping bullish.
So if I ask the analysts, where do they see the price going in 2026?
The consensus is, it's wide. The conservative estimates are sitting around 48 cents, so a modest gain. But the bullish cases, assuming the CME futures drive real volume and those stablecoin integrations actually work, they range from $1.20 up to $1.85.
That's a potential 3x or 4x from where we are right now.
It is. The verdict from a lot of analysts is that ADA is behaving less like a volatile growth stock and more like digital infrastructure that is just waiting to be repriced. It's undervalued relative to its utility and security, but the market is waiting for that utility to translate into real volume.
It's waiting for the water to actually flow through the new plumbing.
Exactly. The pipes are being laid right now with that 70 million ADA fund. 2026 is the year we find out if the water starts running.
So to wrap this all up for you listening, it really feels like Cardano has entered a new phase of maturity. It's not just a science experiment anymore.
No, it has successfully transitioned to self-governance. Voltaire is real. It has a clear scaling roadmap with Hydra and Laos. It has a privacy sidechain in Midnight that's actually live, and it's finally spending the money to buy the institutional access it's always needed.
And it did all that without rebooting the network once or compromising on that core high-assurance philosophy.
Which brings us to the most provocative thought for 2026. We live in a world now where regulation is strict. Governments are cracking down on illicit finance. They're demanding privacy compliance.
So the boring stuff suddenly matters a lot.
Exactly. While the move fast chains are maybe dealing with outages or regulatory lawsuits, ask yourself this. Is the boring, slow academic rigor of Cardano actually its biggest competitive advantage? The tortoise might just be walking right past the hares because it built a shell that can actually withstand the weight of the real world.
Sometimes boring is just another word for reliable. And in finance, reliable is everything. I want to encourage you to look at those boring details, the governance votes, the peer-reviewed papers, because that's really where the longevity lies.
Couldn't have said it better myself.
Thanks for diving in with us. We'll catch you on the next one.